I'm Charlotte McLeod with the Investing News Network, and here today with me is Peter Schiff, President and CEO of Euro-Pacific Capital. Thank you for joining me today.
Well, thanks for having me.
Yeah, that's great. So we're actually here at the International Metal Writers Conference. You'll be speaking later today about the economic bubble in America. It's a complex topic, but could you talk a little bit about what an economic bubble is and how we got one in the U.S.?
Well, a bubble would be an economy that is really not sustainable. It is based on, in our case, artificially low interest rates provided by the Fed, and the extent to which the United States is able to live beyond its means by borrowing money from foreign creditors to pay for products that we didn't produce. So our economy is a bubble. It's not a sustainable economy that is based on underconsumption and capital investment and savings and production. It's based on debt and consumption and cheap money. And I think the bubble has gotten about as big as it's going to get. And I think when this thing pops, look out, because there's a lot of air that's going to come out.
Okay, is that a thing that's going to happen quite soon, or a little further into the future? Do you have a time frame for that?
Well, in the scheme of things, it's going to happen soon. I mean, when they write the history books about this time period, this is the time period where this bubble comes to an end. But whether soon is this year or next year or even several years in the future, I can't know that. In fact, I would have thought, had you done an interview with me, 8 years ago, 10 years ago, I would have thought that the crash would have happened by now. But it hasn't, not because I was wrong about predicting it, but just because the bubble has gotten so much larger. Now, I never really put a time frame on it and said, oh, this is the year it's going to happen, because I don't know. But what I do know is that it's coming, and I do think investors should be prepared for it.
How should they be prepared? What do they need to be doing right now to get ready for that?
Well, they need to invest in the asset classes that will do well when this bubble pops. And you have to recognize that the bubble really is in the US dollar and dollar-denominated instruments, such as bonds that pay in US dollars, or financial assets that trade in price in US dollars. And so people need to get protection from that, although the US dollar isn't the only currency that's going to lose value. And America isn't the only economy that has a bubble, but I think America's is the largest. And so I think the most damage will happen to the dollar and people that are investing in the US. So people need to look for real safe havens, which is one of the reasons that I'm here at this mining conference, because obviously gold is going to be one of the best safe havens around. And companies here, there's a lot of mining companies here that are actually going to be sitting on gold reserves that are going to be far more valuable in the future than they are today.
So would you recommend buying some physical gold, buying gold stocks, a little bit of both?
That depends on your time horizons, your risk tolerance, what your objectives are. If you're just trying to preserve your wealth, then just owning physical gold is the way to go. If you're trying to really grow your wealth, then you may achieve that with gold mining stocks. Of course, you could achieve the reverse. There's a lot more risk in buying into a company that mines gold. And of course, there's a lot of companies here that are exploration companies. They don't even have gold, so they're hoping to find it. So that's even riskier than the companies that own it and just want to get it out of the ground. But of course, there's a lot of complications. It might be that you have gold, but it may cost more to mine it than it's worth when you go to sell it. But of course, that will change. If the price of gold goes as high as I think, then some of these mining companies that can't profitably mine gold at $1,200 with gold at $2,000, $3,000, $5,000, all of a sudden it's a different dynamic. And now gold that's worthless because it's too expensive to extract it now is very valuable.
Okay, and do you have a gold price prediction? How high do you think it could go?
Well, there is no limit to how high gold can go, because there's no limit to how low the dollar can go or other fiat currencies. So it's not really that the price of gold is going up, it's just the value of paper currencies is going down, and you can measure that loss of value with the price of gold. But there is a limit to how expensive gold will get relative to wheat or oil or copper or other commodities that historically have relationships with gold. You're talking about real things, but there is no real value to any of these fiat currencies. They can all ultimately go to zero, and if the dollar is worth zero, then gold's price is infinite.
Okay, so we've talked a lot about gold, the US dollar, how that relates to commodities prices, but China also has a huge impact on commodities as well. And they were just downgraded for the first time in quite a long time. Can you tell me how that could play into commodities?
Well, I think ultimately the Chinese are going to be even bigger buyers of commodities in the future than they are today, and they're already pretty big buyers. I mean, we're here in Canada, and China buys a lot of commodities from Canada, but I think they're going to buy more when they finally abandon their currency peg. And I think right now you have a lot of traders who have been betting against the RMB and they've been shorting it, and that's probably part of the reason that you have this downgrade. But I don't believe that Chinese bonds are going to go into default. I mean, the Chinese are borrowing in their own currency, which they can create. What you need to look at when you're rating the credit of a sovereign is, are they going to be in a situation where they create inflation, like the United States, right? A lot of people will think, well, you know, the U.S. Treasury will never default on U.S. debt, so therefore it should be rated AAA. That's not the point. Even if we don't default, we're going to inflate. It is impossible for the U.S. government to repay its debts in money with purchasing power. So they're going to end up defaulting through inflation. Now, I don't think the Chinese are going to do that. I think Chinese government debt would be safer to hold than U.S. government debt. And I do think when we hit this dollar crisis, and I think it's coming, I think the really big move in the Chinese currency is going to be up, not down. And I think the speculators who are shorting the currency are going to end up losing a lot of money. And as that Chinese currency goes up, so too will demand for commodities from Chinese consumers that now have much more valuable currency to buy commodities. And so what will happen as the Chinese RMB goes up, commodity prices in China come down, demand for commodities in China goes up, and now China is going to be importing a lot more, raw material.
Okay, all right, thank you for that explanation. Those are all my questions for today.
That's it, huh?
That's it. Thank you. Thank you for joining me. Once again, I'm Charlotte McLeod with the Investing News Network, and this is Peter Schiff.